Let's get talking, and I'm starting the show this week with a senior economist at STIRS, Sis Dumebi Oluwole. Thank you so much. It's good to have you join the program.
Thank you for having me.
Yes, I think the first thing for us to start off with is the fallout of the July MPC meeting that has seen another rate hike. What do you make of this in all efforts aimed at reining in on inflation?
I mean, it's not too far-fetched, considering that the central bank is still maintaining its stance on price stability. We saw that June inflation numbers increased, and this is primarily on the back of exchange rate pressures. So because of that, we did expect that the central bank was going to hike. Actually, we had like a scenario analysis for our forecast, and where we predicted, a 60% chance that the CBN was going to hold, looking at the 3 or 4 critical indicators. That's inflation, the exchange rate. That's inflation and inflation expectations, exchange rate and exchange rate expectations, and output growth, right? So the primary drive that we had, then we also had a 40%, probability that the central bank was going to hike. And that 40% chance was primarily on the back of exchange rate pressures that we had seen. That was more aggressive from June up until the meeting on July 22nd and 23rd.
Well, it's a good way to start our conversation, I must say. But if we look critically at some of these moves, like many would say, the removal of subsidy was almost all the presidential candidates agreed that was the way to go. But some would say, what was the plan for the fallout after the removal? Maybe that is what we didn't get clearly. I don't know if you would like to react to that.
Sure, and I'll react to it as an economist. The subsidy in itself, one of the reasons why the conversation about removing it was very strong was simply because it had become unsustainable, right, for the government to keep having that subsidy on. Nigeria wasn't increasing its revenue substantially, and so the subsidy in itself was now becoming a leakage on government funds that was not really doing what it's supposed to be doing, right? So unfortunately the timing of it, right, was not the best, because Nigeria was already experiencing significant exchange rate pressures at the time. Inflation was really high, but then again, it was something that still had to be done. So looking at the fallout of the subsidy removal, obviously we see that temporarily that subsidy payment is somewhat back. We also see that it's not still, even with the subsidy removal, we're still seeing like price transparency is not at its best. NNPC prices are still very lower than, what other marketers are having on their own pumps. You're still seeing that there's still queues. So it hasn't really solved the problem when you really look at it. But the important thing here, when you look at subsidy removal and how it happened, is number one, the communication about how it happened, and number two, how it has been managed so far. And on that front, we do see that a lot of things are lacking, and this is one of the reasons why we are saying that investor sentiment towards the Nigerian economy is still very bearish, despite the fact that we're taking up all of these reforms. Remember that subsidy payments, the brunt of subsidy payments is on consumers, right? And removing that subsidy means that consumer income is squeezed. And this has a spillover effect on businesses and investors, at large. Then you look at the fact that the government is really not cutting its own spending, right? So you're still maintaining subsidies temporarily, yet prices are high. There are still queues. We're seeing frivolous spending on some other aspects of the economy that really don't make sense. And so, the management of it has not been the best. So yeah, I can understand why it doesn't look like it's still. I can understand why it doesn't look like a sensible move as to why the subsidy was removed at the time that it was. So yeah.
Very interesting. We also see in recent times fuel queues are back. Yes, NNPC is saying a bit of disruption again. And of course, this will tell as we move on. And minimum wage, 70,000 naira has also been approved by the federal government. So moving forward, yes, as an economist again, what should we be expecting in regards to figures around Nigeria's economy? Because many say that the hike in inflation in minimum wage might also affect inflation moving forward. Yes.
Yeah. So you've asked two important questions. So I'll start with the cues. So clearly, what this means to one extent, because right now there's no economic fundamental backing why Nigerians should be experiencing fuel scarcity or even long queues at petrol stations. We've removed the subsidy. The expectation is that it should be easier for marketers to bring in fuel and then supply at their price, and people should buy from wherever they want to. But that's really not happening. Remember, I said price transparency is still not at its peak. So clearly, what this looks like is a case of artificial scarcity, and chances are that the prices of fuel would increase again, and that's why this is happening. So until we see the market stabilize, this is where we see things landing in terms of why these queues are resurfacing and why people are experiencing this right now, especially ahead of the protests that have been planned to happen. Then the second thing about the minimum wage. So yes, there are expectations that the minimum wage would have an inflationary effect, especially when you consider the fact that everyone is supposed to experience this increase in their wages nominally, right? When you consider the fact that we have a lot of ghost workers in the public sector, you consider the fact that there's still a lot of loopholes with salary payments, you do understand the reason why we're saying that there's going to be a huge inflationary effect from the minimum wage increase. But when we start discounting for inflation and we also discount for the fact that companies have to pay this and the kind of companies that have to pay this, you will see that this inflationary impact that we're expecting might not happen, at least in the short term. And by short term, I mean in the next 3 to 6 months, right? Or even up to 12 months even. So let us put this into context. Who are the companies that are going to pay this increase in salary wages? We have 96% of these businesses are small to medium scale enterprises. And what has happened to small to medium scale enterprises over the past year since the reforms have happened? We've seen about 25% of them shut down. We've seen them experience low revenues. We've seen them experience low profit margins. We've seen them even shrink their employees just simply because, the brunt of all of this is huge on their revenue. So chances of them implementing this minimum wage when it does kick off at large scale is very slim, right? They will need to rebalance their books. They will need to ensure that output is optimal so that they're able to pay this money, right? So the chances of this happening in the short term is pretty slim. And we do expect that this would somewhat net off the inflationary impact of the minimum wage. Then you also look at the fact that even when people are getting paid this money, inflation is still going to bite at least 30% of that away, right? So their real income is still pretty much low, especially when you even now discount for the exchange rates, right? You convert about 70,000 naira in US dollar terms and then convert that to a bag of rice, convert that to a bag of beans, or even half bag of that, convert that to pepper, convert that to tomatoes. You realize that people might not still be able to spend as much to create that inflationary shock that we do expect. Although on a large scale, if this is implemented at once, when again mentioning the public sector, you can understand why this is a concern, and the CBN might want to hedge against that. But I don't think that we don't think that this is going to be something that will be significantly impactful or significantly inflationary in the short term when you discount for all of these things that are happening at the same time. I think one last thing to also consider with the minimum wage is that the federal government is also implementing a 150-day duty-free imports for certain commodities, right? So with this happening, coinciding with the fact that companies might not pay this immediately, coinciding with the fact that, aggregate demand might not be significantly increased, when you put all of this together, you will see that the inflationary impact of this minimum wage in the short term is not as strong.
stuff. Let me take you to the market space now. Let's stay a bit around the equities market before we wrap up this conversation. And I want to ask you why you think Nigerian corporates at the moment is shying away from capital markets, even as cost of debt increases. What is happening in that space?
Again, it boils down to investor sentiments, right? There are a lot of bearish investor sentiments towards the Nigerian economy, and you really can't blame investors right now. A lot of things are happening at the same time. We're not yet seeing the kind of fiscal aggressiveness that one would expect in terms of, again, thinning, government spending. We're just seeing the government significantly take from both businesses and consumers. And that is a very, for lack of better words, I would say it's very scary to investors, because the chances are that if they bring in their money, it could be taxed, right? So they would not want to keep their money in Nigeria for the long term. And we're seeing this bearish investor sentiments across the board, even with fixed income instruments, right? Then you also consider the fact that interest rates on fixed income instruments right now, they're more favorable, right? I put in my money for 3 months. I'm able to get as high as 17% on my investments. I might as well do that than, equities markets that is getting hit, from different sides. Then again, I would say for the equities market, one of the major things that triggered this huge bearish investor sentiment is, I would say the adjustment or amendments to the Finance Act that's going to definitely cause a lot of ruckus for Tier 1 banks. And Tier 1 banks, if you remember, have been the huge beneficiaries of the equities, or huge drivers, and movers of the equities market, at least for the past 7 months now. So with them being affected, and also with them being affected, chances are that, investor sentiments towards their stocks as well is bearish. Typically, I'll also say the protest happening, there's huge uncertainty around that. So one of the first places you will see how the economy is feeling, right? How the markets are feeling towards a lot of things that are happening in the economy is with the equities market. And you also see that with the protests happening, this has been priced on equities. And that's one of the things that is also influencing, the bearish sentiments that we're seeing there.
Before I let you go, let's speak around growth projections. We've seen a review of projections, yes, again and again. IMF and the World Bank coming up to review. I think we stand about 3.1% at the moment. What do you make of this, considering the expectations from the ongoing reforms?
I mean, again, it's not far-fetched. If you just look at what's happening in Nigeria, you can understand why our growth projections are revised downwards. Businesses are not producing at optimal levels. They're experiencing increase in taxes, they're experiencing weak demand, they're experiencing exchange rate pressures, all of which determine how much they're able to produce and how much they're able to sell and how much they're able to make in terms of revenue and how much profit they're also supposed to make, right? And the businesses that are significantly affected, they do comprise a lot more of our GDP, right? So the services sector, trade, the real estate sector, agriculture, manufacturing, right? So these are the sectors that are hard hit right now with the reforms in place and all of the other macroeconomic challenges that Nigeria is facing today. And a very good pointer to what is going to keep happening with our growth is the PMI indicator. So the Purchasing Managers Index is one indicator, one forward-looking indicator to GDP growth. And it captures a lot of the private sector activities. For Nigeria primarily, if you dig deeper into the kinds of businesses that the PMI tracks, you will see that they are the small to medium scale enterprises and to an extent some large corporates. And these businesses account for over 80% of output in Nigeria. And if they are significantly affected, you will see, our GDP growth numbers reflect this impact, this negative impact on their operations. And significantly, we've seen our, I think for the second quarter, we've seen a decline in Nigeria's PMI reading. significantly compared to Q1 2024. And that obviously means that GDP growth in Q2 will decline. And when you look at what is happening so far leading up to Q3, we're not still producing enough, especially from crude oil. Non-oil exports earnings as well are looking like they're going to decline, especially from cocoa. You look at what's happening with cashew, it's also declining. Look at what's happening with sesame seeds, it's also declining. Then you now consider gas, same thing as well. And then you look at the services sector as well, they're also being significantly constrained. That obviously points to the fact that our growth will also decline in Q3. So yes, pretty much that the revised projections are not they're not far-fetched, and it's something that we do expect, except if by some significant change we see things significantly turn around towards the end of Q3. But right now, things are still very low. Yeah.
Yeah, wait for that turnaround. Very importantly, thank you so much for starting the week with us. Dumebi Oluwole is a senior economist with Stairs. Thank you, and really do have a productive week.
Thank you. You too.